What if I told you that your bank account is, quite frankly, lying to you about your business's success? I know, it sounds a little crazy, right? Because we are completely conditioned to just look at our cash balance and think, hey, there's a bunch of money in there, I must be doing absolutely great. Or, on the flip side, we log into our banking app, see that the cash is dangerously low, and completely panic, thinking, oh no, my business is failing. But what if that cash balance is really just an illusion? An illusion created by timing. What if the actual ground-level reality of your business's performance is completely disconnected from the exact moment the money happens to move in and out of your account? Well, strap in, because today we're tackling this massive timing problem of cash versus actual business reality.
Welcome to this explainer. Today, we are basically embarking on a financial detective story. We are going to solve the ultimate puzzle of when money actually changes hands versus when the real substance of a business transaction actually takes place. You can kind of think of your accounting system as a time machine, right? And it constantly gets pulled out of whack by the messy reality of the real world. So we have to use this incredibly powerful secret weapon called adjusting entries to fix that time machine and sync it back up with reality. Let me tell you, if you want to truly understand the real financial health of a business, whether you're an investor looking to put money in, a lender evaluating a loan, or a business owner just trying to survive, you absolutely must master this concept. It's a total game changer.
So, to really wrap our heads around why we even need these adjusting entries in the first place, we have to draw a stark, plain English line between two completely different ways of looking at the financial world. On one side of the ring, we have cash accounting. Now, this is super simple, right? You just record things exactly when the cash physically enters or leaves your bank account. Easy enough. But large businesses and major international standards like GAAP and IFRS, they absolutely demand something entirely different. They require what we call accrual accounting. And accrual accounting is all about tracking when reality actually happens. It tracks the true substance and the real economic impact of a transaction, completely regardless of when the cash moves or when the invoice finally shows up in the mail. It's about truth, not just timing.
Which brings us to this absolutely crucial point. This is basically the golden rule of accounting, okay? Revenue is recognized as it's earned, and expenses are recorded as they are incurred. This rule is literally everything. Think about it. A completely normal standard transaction really has three moving parts. You have the actual transfer of a good or service, you have the piece of paper, which is the invoice, and you have the hard cash payment. Now, if all three of those things happen in the exact same month, fantastic. Everything is perfectly synced up and you don't need any adjustments at all. But welcome to the real world, where those three parts almost always fall into totally different past or future accounting periods. When that happens, our financial statements get massively distorted, and that, my friends, is exactly when we have to step in and manually post adjusting entries to drag our books kicking and screaming back into line with reality.
So, here is our mental map for today's explainer. We've got 4 distinct quadrants we're going to explore to solve this whole puzzle: prepaid expenses, deferred revenue, accrued expenses, and finally, accrued revenue. Let's just dive right into the first one.
Quadrant 1, prepaid expenses. This is all about paying for the future.
Okay, a prepaid expense is honestly exactly what it sounds like. It's a future expense which has been paid for in advance. What this means in plain terms is that we made a big cash payment in the past, but we aren't actually going to receive or use up the underlying goods or services until some future accounting period. To really bring this down to earth, I want you to imagine a car. Let's call her Betty. Betty is an older Toyota Yaris living out in Vancouver. She is definitely not the fastest thing on the road, but she gets you from point A to point B reliably every single day. Now, insuring a car like Betty in a busy city like Vancouver is seriously expensive. So imagine having to pay a whopping $2,400 for a full year of car insurance, and you have to pay it entirely upfront in cold hard cash in mid-December. Let's actually map out the timeline of reality versus cash for Betty's insurance, because this is where the disconnect happens. On December 15th, boom, $2,400 in cash instantly leaves your bank account. Now, if we were just doing lazy cash accounting and logged that as a massive expense right there in December, your December profits would look absolutely terrible. It would look like you had the worst month ever. But hold on a second. We haven't actually consumed any of that insurance yet, right? The true reality of the situation is that the benefit of driving Betty safely around town will be consumed slowly, month by month, from January 1st all the way to December 31st of the following year. So how exactly do we fix this time machine? Well, at the end of December, instead of taking that huge expense hit and ruining our profit margins, we essentially park that $2,400 safely over on the balance sheet. We put it in a bucket called an asset, specifically prepaid expenses.
You might be wondering, why on earth is an expense considered an asset? Well, because it legally guarantees us a future economic benefit. We literally get to drive for an entire year without paying another dime. It's valuable. Then, as reality actually unfolds, we step in with our trusty adjusting entry. Every single month, we pop just a little bit of that protective asset bubble. In January, we officially consume 1/12 of that yearly policy. 1/12 of $2,400 is $200. So we manually reduce that protective asset bubble on the balance sheet by $200, bringing its value down to $2,200. And then we shift that exact $200 directly over to the income statement as a true realized insurance expense for January. We just repeat that exact same step every single month until the asset drains down to zero, and the reality of the expense perfectly matches the timeline of you actually driving the car.
Okay, so we've just seen exactly what happens when we, as the business, go out and buy something really early. But let's flip the script entirely. Let's look at the exact opposite perspective. What happens if you are the seller and your customer walks in and hands you a giant stack of cash before you've even lifted a single finger to actually do the work?
That brings us right into quadrant 2, deferred revenue, getting paid before the work is done. Deferred revenue, which by the way you might sometimes hear folks call prepaid revenue or unearned revenue, represents payments a business receives in advance for goods or services that have not yet been delivered. Now, listen closely here. If you just take that cash, throw it in the bank, and immediately record it as revenue on your books, you are flat out violating our golden rule. You absolutely haven't earned it yet. To picture this, think about a commercial airline. Let's say a customer goes online and buys an $800 return flight from Vancouver to the UK because they're feeling a bit homesick.
Let's really map out this timeline so you can see the trap here. It's June and the customer clicks buy. The airline instantly receives $800 in cash. Incredible, right? Well, not quite yet. Because the actual outbound flight to London isn't taking place until July, and the return flight back to Vancouver isn't happening until August. If the airline's accountants just blindly recognized all $800 as pure revenue right there in June, they would be massively and artificially inflating their performance for that month. Because reality tells a different story. They haven't provided the service yet. They haven't burned the jet fuel, paid the flight attendants, or made any of the necessary economic sacrifices to actually earn that cash.
Because the airline literally owes the customer a service, that $800 in cash is actually a liability on their balance sheet in June. Yes, a liability. They're entirely on the hook to do the heavy lifting later. Then we fast forward to the end of July. The outbound flight lands in the UK. Half the trip is complete. The airline has now officially earned half of that ticket money. So what do? They post an adjusting entry. They shrink that liability down by $400, and they finally, beautifully, get to recognize that $400 as true earned revenue on their income statement. Then August rolls around, they fly the customer all the way back to Vancouver, finish the job completely, clear out the very last of that liability, and record the final $400 in revenue. By doing this, they create a perfect, seamless harmony between what the accounting books say and what actually happened in reality.
All right, moving right along to quadrant 3, accrued expenses. Using now, paying later. We are now dealing with the really sneaky, invisible expenses that just quietly build up in the background of a business. So, an accrued expense is a past expense that simply hasn't been recorded or paid for yet. I want you to think about everyday utility bills for your business, right? Like your water or your electricity. The local water company doesn't send a guy to bill you every single afternoon you turn on the office tap. You might actually be using water in your facility for 2 or 3 months straight without ever seeing a single piece of paper or an official invoice from the supplier. But, and this is a huge but, just because you haven't seen a piece of paper in the mail doesn't mean your business hasn't incurred a very real, tangible economic cost during that time. Here is the exact step-by-step process we have to follow to stop our monthly profit from being horribly distorted by this delay. In a normal world, an invoice finally arriving in the mail acts as what we call an accounting trigger. You grab the invoice, you enter it into your accounting software, and boom, the expense is officially recorded. But if that invoice is delayed for months, we have a serious problem. So, Step 1, the service is being used over time day by day. Step 2, because we have absolutely no official trigger from the supplier, we literally have to step in, estimate the expense ourselves, and manually record it month by month as an adjusting entry. Then, Step 3, when that official piece of paper finally arrives in the future, it acts as the final trigger to true up and settle the whole thing.
Let's look at the numbers to make this crystal clear. Let's say your business gets billed for water on a quarterly basis. But based on your history, you estimate that water costs you roughly $50 a month. In November, your team uses the water, but of course, you get no bill. You can't just pretend it was free, so you post an adjusting entry. You proactively recognize a $50 expense on your income statement for November, and you simultaneously record a $50 accrued expense liability on your balance sheet. Why a liability? Because you are legally committed to paying for this eventually. You do the exact same estimation routine in December. Add another $50. So now, entering January, your books accurately show $100 in past expenses. Finally, January rolls around, and the actual quarterly invoice drops in the mail. And let's say it's for $153. Your accounting software might just try to automatically log that entire $153 expense all into January. But wait, if we leave it exactly like that, your total expenses are going to be wildly overstated because you already claimed $100 of it back in November and December. So, your final adjusting entry gracefully reverses that $100 liability placeholder you built up, leaving January's income statement to only absorb the true remaining reality of just $53. It's brilliant.
And that brings us to our final stop. Quadrant 4, accrued revenue. Working now, billing later.
Accrued revenue is revenue that has been fully 100% earned in the past, but the client simply hasn't been invoiced yet. Honestly, this is the ultimate classic freelancer dilemma. You put in the late nights, you drank way too much coffee, you delivered an absolutely amazing final product to the client, but because you were just so insanely busy doing the actual work, the admin paperwork totally lagged behind. You just forgot to send the invoice. But remember our golden rule from the beginning. Just because you haven't attached a shiny PDF invoice to an email doesn't mean your business didn't create real value and legally earn that money during that specific time period.
Picture a super talented freelance web developer. On June 1st, they sit down at their keyboard and start coding a brand new website for a local small business. On June 30th, right at the buzzer, the website goes completely live on the internet. The client is absolutely thrilled, and that $500 development fee is fully, officially earned. The work is done. But our developer is completely swamped with their next big project and just doesn't actually get around to typing up and sending the official invoice until, let's say, mid-July. If this developer stubbornly waits until July to actually record the revenue in their system, the month of June is going to look like a completely terrible, totally unprofitable month. And July is going to look artificially fantastic. That is a massive distortion of the actual reality of how this person worked.
So here's exactly how we use an adjusting entry to fix this specific time machine. At the very end of June, the developer steps in and posts an adjusting entry to officially and proudly recognize that positive $500 in revenue right there on their June income statement. Why? Because they did the hard work and they earned it. Now, the other side of that entry has to go somewhere, so it goes over to the balance sheet as a $500 asset temporarily called accrued revenue. It's an asset because it clearly represents a future economic benefit. It's cold hard cash that is rightfully owed to them. Then in July, when that official piece of paper, the invoice, is finally raised and sent to the client, the revenue doesn't get touched on the income statement at all. It stays safely locked into June where it belongs. Instead, over on the balance sheet, that $500 asset simply jumps categories. It moves from the temporary accrued revenue bucket right over into accounts receivable. And eventually, down the road, when the client finally writes the check, it jumps one last time from accounts receivable straight into the actual cash account. The timeline is saved.
So let's just take a breath, step back, and look at the whole big picture here. We have actually solved the puzzle. We've successfully conquered all 4 time shifts of business accounting. We have our prepaid expenses, where we pay the cash right now but slowly use up the benefit later. We have deferred revenue, where we gladly take the cash now but legally owe the hard work later. We have accrued expenses, where we are using up a service right now but get to pay for it later. And finally, we have accrued revenue, where we put in the blood, sweat, and tears now, but bill for it later. Adjusting entries aren't just boring math. They are the essential, manual tools we use to ensure our financial statements always reflect the exact truth of what is happening in reality, rather than just the arbitrary random timing of a cash transfer or a delayed piece of mail.
You know, after going through all of this, you are now completely equipped to see right past the illusion of the bank account. The very next time you are evaluating your own business's health, or maybe looking at a potential stock investment, and you glance at that top-line cash balance, I really want you to stop and ask yourself, is this just cash or is this reality? Because once you truly understand the power of adjusting entries, I promise you, you will literally never look at a business the same way again. It completely changes your perspective. Thank you so much for joining me on this explainer, and remember to just keep asking the right questions.